Good morning and welcome to the Saxo Bank morning call for this Tuesday, November 13th. A bit of a bounce overnight, but we had a very ugly session on Wall Street yesterday. It looked like one of the key drivers, an apparent switch in focus. There was a Wall Street Journal article describing this, an apparent shift in focus away from increasingly high tariffs to potentially going after China on so-called IP theft. And that really hit sentiment across the globe, really, but especially in the U.S. session. It looked, Peter, like a lot of the focus was on the tech stocks on this story.
Yeah, because obviously it's tied to the semiconductor space and the general technology space. And what we saw was an immediate around 60 or 70 points drop in the Nasdaq 100 index future. And then we continued lower as the cash market opened. And then we had a small rebound mid-session. And then we had weakness into the close again. And it also took European stocks down, as we talked about before we went in the studio. You had momentum stocks being up 1% in Europe before the news hit. And then it was down 2% at the close. So very ugly session. It spills into what we talked about yesterday, John. I'm not convinced that this is just a buying the dip opportunity. I don't think we'll see a massive rebound. I think it's much more likely that we will test the lows from this year in the Nasdaq 100. The sentiment is really weakening here.
Not that far away.
No.
Kim, we've got a chart here that you provided. A pretty brutal session there. What's your take on the technical situation here?
Yeah, it actually clarifies, or as Peter mentioned, I don't believe we will see higher highs here in the Nasdaq either, or in any market for that matter. You will see very, very strong sellers last night. Throughout the session, actually, yeah, they lifted a little bit midway, but not much, no. and they actually almost ended at the lowest level of the session. So yeah, 6,320 is. I don't see any really strong support before then. So yeah, I do believe in lower lows going into the end of the year.
Also, the last sequence there, last few days, seeing a pretty powerful rejection of the attempt to crawl back above the 200 moving average.
The midterm election euphoria lasted very, very shortly. I mean, it was very short. In 2 days, one day, and then that was over.
You also have the FANG stocks. This is an instrument I actually wasn't aware of. So enlighten us here on the FANG stocks, a future on these stocks, which is also looking potentially a little bit weaker locally here.
Yeah, it's very clear to see that it's not the 8 biggest, but it's Amazon, Apple, Baidu, Alibaba, Netflix, and Nvidia, and those. They have their own future, and it's actually quite interesting. They are actually driving this, it's a future on these stocks, and I don't see any support really here. 23.50 level, as you can see back earlier this year. Last year there was some support there. It's really, really weak, and they are actually driving this much lower. And as you mentioned, Peter, with the story, the story this morning, yesterday, there's not much good news at the moment.
But I think it's interesting going back to our midterm election special we did on that Friday a couple of week ago, where we talked about the seasonality. They had the statistics that on the backdrop of the midterm election, you always see equities rally, and they had the seasonality effects, a strong November and December, and we actually played devil's advocate on this and saying this time it is a bit different, right? Because if we get a disappointing G20, I'm pretty sure that market will sell off heavily throughout December, despite of new money coming in, and then January 1st, we'll have a hike in the tariffs on the U.S. against imported goods from China, and you will probably see a weak January as well. So I think the dynamics are totally different this time around. And if you're playing these calendar effects, I think you're taking a massive round of risk here.
Yeah, and I don't believe in a SaxoStrats rally this year either. I mean,
I think it will be a short, to be fair, to play the devil's advocate again, if we're getting a Xi-Trump thaw here,
of course.
If we get some kind of deal struck, suddenly people will go back to
I agree.
Say, look, the seasonality effect won, when actually it's not seasonality. It's in the hands of Xi and Trump. What's going on here? Back to our charts. There was another weak story driving equities yesterday. The Apple, the market cap king, really, really suffering here. What was the driver yesterday?
So the driver was, and it already started last week when the Nikkei, the news outlet out of Japan, told the story that Foxconn was already scaling down from 60 production lines to 45 on their XR iPhone, which is the cheap version, which only sells for 6,000 Danish kroner here in Denmark, which, by the way, for the listeners that don't know, Danish kroner is a lot still. So, but this cheap,
$1,000,
$1,000 ish, and this phone is seeing waning demand. So, and Apple has now cut orders from other suppliers, and you're seeing one supplier in Asia down 30% in this Asia session, and you can, as you can see, if you take up the chart again, you can just see that shares are heavily underperformed pressure in Apple at the moment. As you can see here, I don't know where the support is. It's probably down at 180 maybe if we just continue from here. So I think that's a key story to follow, talking about the FANGs.
And just to round out the happy vibes in the equity market here, we had,
Yes.
we had a pretty ugly session in Germany or in Europe as well, and you've highlighted the German DAX here, Kim.
Yes, it's very interesting actually what happened yesterday. We opened up about 1% up, and it looks like it to be a nice session. As you can see, I draw this body gap, as we call it, that it actually been trading around and above for about a week or so. But suddenly, I think it was the last hour, 2 hours of the session yesterday, suddenly it just sold off and we closed below. So I see weakness and potentially lower to below 11,000 within the next couple of weeks.
All right. Well, that'll do it for the equity focus. A little bit over on the Forex side of things, where things are finally cooking a little bit, at least in euro crosses. The euro extremely weak. I'm not really sure entirely why the euro is being so isolated here. I can make a laundry list of these long-term uncertainties related to the EU existential problems. Regardless, the euro broke that key 113 level. I showed it on the chart yesterday. I have the chart here today, and that is the break until it is reversed, the break of that 113 level. And then the next focus, already almost here, the 111.87 Fibonacci, which is that lower green line. That's the entire retracement, a retracement of the entire sequence from the early 2015 lows to the early 2018 highs. That comes in just below 112, and I would say potential towards more like 110 if the dollar strength is broadening a bit here. And then on the other news, another euro pair, but not so much to focus on the euro in that pair. That's the Norwegian krone, extremely weak here. We're seeing it even weaker versus the euro. Another negative year-on-year print on the GDP out of Norway this morning. It's toying with the 200-day moving average. I think it was even crawling just a bit above that level this morning, a pretty critical juncture, I would say, for the Norwegian krone. Sliding oil prices and then the weak economy not adding to the sense that the Norges Bank is going to be in any hurry to hike rates there anytime soon. Finally, I just wanted to focus on, we have the whole situation in China, the Xi-Trump summit. It is everything, and another thing that is everything in the foreign exchange space is the Chinese renminbi and whether that that floor is going to be abandoned by China. We're seeing a lot of news flow. Peter and I were talking about it this morning. A lot of news flow. These sudden sort of almost like an olive branch from China on deals, potential for opening up joint ventures. All these sort of waving of arms to indicate that they're going to change behavior and move towards the U.S. direction on a number of fronts. All obviously aimed at significant PR pressure ahead of that big G20 summit. So that's going to be just a critical thing. And another critical thing, and I have a chart here of FX implied volatility at 1 month. You can see how it's just been bottled up in a very low range, pushing towards the upper part of that range here. And I really don't think it's going to have a chance to spread its wings. The market volatility, which would be more in keeping with the volatility, for example, we've seen in the equity market, unless China allows that currency to float in some way or another, or makes a more significant stand in favor of strength. Whatever it is the key issue that is bottling up FX volatility here. Then I think before we get to the calendar, we have the gold is getting pretty interesting. We've seen some pretty significant support giving way. You brought a chart here, Kim, on gold. This rising channel has pretty much given way, and that whole support area around 1210, 1211 that Ole was highlighting in recent morning calls.
Yes, this rising channel it seems to be tested this morning. A break below, well, then we're talking 1180, potentially lower. There's some support there, as you can see, a little bit strong, but let's see if we break the rising trend this morning.
And this oil slide, the other key commodity we focus on, is so persistent. And we tried to, Saudi Arabia trying to support the price, talking about production cuts recently, but the slide just continues apace. I mean, where do you grab on for support in these kinds of markets when the oversold just continues to be more and more oversold?
It is very oversold at the moment, but things can actually be oversold for quite some time. But there is a little bit of silver lining here. There is some support around 58. If we can bring up the chart, then we have some support here around 58. We're very close to that.
WTI.
That's the WTI, yes. The Brent doesn't look that bad, but of course they follow somewhat But 58, I do believe we will see some bounce, at least short term, but the trend really has reversed on this, also medium term.
It's done some serious damage to any sense of a bullish case. Actually, I wanted to bring this up one more time. It's an issue we've highlighted before. If there is one of these systemic issues, one of these areas in the market that could start to develop a snowballing, more of a credit crunch in the corporate space, corporate debt space. Yeah. We've talked about this before, and that is potentially a GE, and we're seeing signs of further pressure and strain on the GE equity price. Peter, enlighten us here. We've seen yet another slide in GE overnight. Was it 7%, 8% yesterday?
7% yesterday. We dipped below 8%, so we are now only around dividend adjusted around 50%. If we go down 50% more, we will touch the lows from 2009, as you can see here on the chart. But I think this is not so much an equity story. It has been an equity story for 2 years now. You can see we went from 30 to 8. So that is itself it's impressive for a more than 100-year-old behemoth within U.S. industry. But I think this is developing into being a corporate credit story. You have a massive plunge in free cash flow and cash flow generation. And that's colliding at the same time as you have around $100 billion of liability. So you have they will be caught in a crosshair here. And I think potentially if GE spins out of control, it could set in motion some domino effects in the corporate credit space. And we know, we've talked about that, the biggest segment within corporate credit that has been expanding since the great financial crisis has been triple B, so one notch above junk. If you suddenly see a chain reaction in the corporate credit market and Moody's and Fitch downgrades a lot of these triple B, you can have triple effects through the corporate credit space. And corporate credit is a different animal than government debt, despite we've been talking about US have a lot of debt on the government side. So watch this story. I think it could be quite crucial.
Yeah, I think it is crucial. We'll round it off with our traditional look at the economic calendar for the day and for the rest of the week. We have UK data pretty hot and heavy there. There's continued noise on Brexit that Barnier, the EU side of things, trying to send out positive noises. However, the issue is within May's cabinet and whether any agreement they make could pass Parliament. So, we have the data here indicating the output gap is turning positive, that the UK economy is running too hot, and the Bank of England will be happy to hike. They've even said they'd be happy to hike in the case of a hard Brexit. So, I don't really see what holds sterling back except the immediate uncertainty of switching to some sort of disorderly Brexit scenario. I don't know, but watch those, especially the earnings figure there at 9:30 GMT, 10:30 for Central European time. Then the ZEW survey out of Germany. This one's been very, very, very negative and showing the potential and the worry that the expectations are declining in Germany. It's a surplus economy. If we are headed towards trade wars, if the economic cycle is beginning to turn, Germany could be one of the worst hit companies. Fed Chairman Powell out speaking tomorrow. We have these conferences going on and summits going on out in Asia with Vice President Pence from the U.S. in attendance, but it's all about that end of November, 1st of December. G20 meeting and the Xi-Trump summit, I think, is where the markets are really going to key off in all directions, really. Risk appetite, foreign exchange. We'll be watching that issue closely, and we'll try not to be a broken record every day talking about that summit, but that'll be, of course, a key focus. That's it for today. We'll be back tomorrow.